What's going on, everybody? Welcome back to my YouTube channel. Now, in today's lesson, I want to talk to you about where you should be placing your stop loss. Now, I just want to say this from the outset. There is no right or wrong place to place your stop loss. Now, when you place your stop loss, guys, it is relevant. And what do I mean by that? Well, you have to decide where you are comfortable for your stop loss to be. But there are a few principles that you can consider when trading. Maybe if you're entering trades and you find yourself being stopped out too regularly, or maybe you're placing your stop loss in too far of a place where you find it very difficult to get to TPs. Today, we're going to go through a discussion on things you can think about and where you could be placing that stop loss to truly maximize your potential. But I do want to say this for the record. You should be focusing on your risk before your reward. So let's look at 5 areas that you can consider where you could be placing your stop loss for optimal results. The first is a trend. Now, I might get some backlash for this video, guys, and I understand why, because everybody thinks they're right in terms of where things should be in this industry. I'm just talking from my experience, and I'm going to share some principles with you for you to consider where your stop loss can be so that we can avoid some of the scenarios where you find yourself being stopped out prematurely or you find yourself stuck in trades for too long because your stop loss was too big. The first principle that I follow is a trend-based rule. Now, when we're looking at the structure of the market, remember, there's never going to be structures that are going to be perfectly aligned. If you're waiting for perfectly aligned structures, that's fine, but you will be waiting some time for the structures to develop for you, especially if you're looking for the trends, because the market very rarely trends, unless you're trading lower time frames. But let's say I'm looking at this structure here on the market, right? First thing that I'm identifying is that we've had a very strong push to the upside. I can see price is starting to deplete in that bullish sentiment, and we're starting to fail to break the highs. We're seeing a shift to the downside here, and we've got an area in the market which we can identify as a structural higher low. Now, when a higher low is formed, what we expect the market to do is make a higher low, continue bullish to make a higher high. In this instance, we didn't. We broke below these levels, and we've come back to in and around this level. You can just call this a break and retest for a potential trading opportunity. Now, when I'm looking at this, and I'm not here to talk about structure too much on this video, but what I want you to consider is if you're taking this trade with the assumption that the market is going to continue bearish for the reasons that you've identified, and you opt to take a trade, let's say, on the break of this low, okay? These are my favorite kind of setups where I'm looking for sell stop entries. The question really here is this: where should you be placing your stop loss? Well, there's a few things to think about here in this instance, okay? Firstly, we know that there's a new developing trend, meaning that if the market makes a structural high, a low, a lower high, there's a very high chance that we make a new lower low. That's just how the market develops. Now, if we place our stop loss here, there's a couple of things that can happen. Price will either continue down from this level to make a lower low. Price will come back to this level to respect it, to make a double top and continue lower. Or until price has made the new low, it will continue to respect the previous structure, which means that if you enter the trade, there is still a chance that price can come back to this high before going down, because the downtrend does not get formed and does not continue to form until price breaks a structural low. So in this instance, even though we have the lower high, it is not confirmed until we've broken the low and we continue lower. So in an instance like this, price breaks the low, then in theory, price should continue to respect the lower high, because in a downtrend, until it breaks the lower high, we are still in a downtrend. But if you enter this trade and price continues in this direction, there is still a chance that price could come back to this structural high and continue down. Now, there's no right or wrong place to place your stop loss in a scenario like this, but what you got to be considering is this: how many trades do I take where I place my stop loss behind the lower high or the higher low in a downtrend or an uptrend? The market comes and stops me out before continuing in my direction. If that is happening more often than not, then guys, the rule of thumb that you need to follow is placing your stop loss above the previous structure. In that instance, you'll find yourself being stopped out less, and with the idea that the market will continue bearish, you give it the best opportunity to breathe, as structure likes to do, before then continuing the direction that it intends to go. If you're finding that you are taking a lot of trades and price is not even coming back to the previous structure, and you are identifying high probability trading setups where price is respecting the trend, that's the rule of thumb that we're talking about today, the trend, then you will place your stop loss behind the assumed lower high with the idea that it will continue to make a downtrend and not break its lower high. Now, wherever you put it, in these two instances is 100% correct. So if I'm in a trade and I find that I'm identifying high probability setups, this is a 5-minute time frame, I'm identifying strong behavior on the 4H or the 1H, we have a bearish candle close, the new candle's open, created a top wick, and now it's continuing bearish, and we flipped when I'm entering the trade, then I'm going to assume it's going to continue bearish. I don't really necessarily need to worry about having my stop loss above this high, because I'm taking the trade with the assumption that the current higher time frame candle is bearish and it will continue bearish. Let's say maybe I'm taking a reversal. We're starting to form a downtrend with a strong 4H bullish candle, and I'm looking to take the retracement of that candle. If we make a structural high on the 4H candle, and this is the highest point of that candle's formation, and I know that if I'm taking a retracement, I'm anticipating for that bullish 4H candle to retrace and go bearish, then there's a higher chance that price could come back to the highest point. So in an instance like this, I'm more than likely to put my stop loss above this high. Now, I don't really want to talk about TPs, but if I have a much bigger stop loss, then the chances are I'm going to go for a smaller target. It's that simple. You've got to balance out the odds. A bigger stop loss means that your targets are going to be less likely to be hit because you need the market to do a lot of work. Unless you're swing trading, but I'm a day trader, so I'm focusing on trying to get in and out of the market with the behavior of a single candle or two candles. If I get a good stop loss placement, then the chances are that I'm going to go for bigger risk to reward. And the reason for that is because the range that I'm asking this candle to move is this much with a smaller stop loss. And then if I have a bigger stop loss, the range of that candle is going to be this much. I can't assume just because I want a bigger target that now I should expect the higher time frame candle to create a bigger range for me. It doesn't work like that. Because if the assumption is that my TP can be hit within this range of a single or two candles, then why should I assume that my TP would be hit just because I have a bigger stop loss and now I want a bigger range candle? It just, the assumption doesn't make sense. Okay. So the first rule of thumb is in trends is to make sure that your stop loss is behind the current low, higher low, lower high, and or above the previous lower high or higher low. The second rule of thumb here that we're going to be looking at is key levels. Now, it's very important to understand if you're a reversal trader, you're a continuation trader, the market will respect key levels. So let's say in an instance like this, we draw in our key level. We can see that price has made a structural low. We've come back into this level. Let's assume this wasn't here. Okay, it's broken it, whatever else. But let's just say we come and we see the market coming back to this level and respecting it. Now, is this key level still valid? Well, of course it is, right? Price broke out of this level, was broken back in, and we've come back to this level and we're respecting it. Okay, so the rule of thumb is key levels are usually respected by the market. So with that being said, if the market comes back to this level and this is when you're planning to trade, then this is a tradable opportunity. The question is, where do we put our stop loss? Well, if you're a key level trader, you're more than likely going to put your stop loss below the key level in anticipation for price to respect that and continue bullish. Now, again, very simple thought process here. If you find that you are taking trades at key levels and the market stops you out before going bullish and or going bearish, then you need to reconsider how you place a stop loss. Let's say that we didn't have this breakout, or let's say in this instance, we do have this breakout and this break back in of this structure. We have to understand and accept that the market has previously been down to this area. If it wants to, it will continue down to that area. And more than likely, if this is the lowest point, this is where price is going to respect. If price is respecting the previous level within the current data, then it's completely fine to put your stop loss below here. But if we get evidence of the market creating structural lows, even if it breaks back in, the wisest thing to do, guys, is to put your stop loss here. This is the wisest thing to do. Why? Because if the market decides to trigger you in, come back and stop you out, and then go bullish, what we want to be doing here is we want to be avoiding the emotional and mental distraught that we're going to face from saying, I knew the market was going to go bullish, but it stopped me out before going bullish. And if I just put my stop loss below this level, which was the lowest point, which is literally 3 more pips, I would have survived this trade and I could have had a TP. Now, most people will put their stop loss here because they want the big risk to reward. But again, another thing you need to think about here is this. You must be focusing on risk before reward. There are so many trades that you're going to enter that you know the direction of the market and you're going to be stopped out, and you could have just taken 1R, 2R from the markets, and over a period of time, a week, 2 weeks, 3 weeks, 4 weeks, that accumulates. If you're constantly going for the home runs, you're going to find yourself in a pickle. So in a stop loss, in a situation like this, these are the things you want to be thinking about in terms of a stop loss placement. The next rule of thumb that you want to be thinking about here is putting your stop loss below swing lows and swing highs. Now, it's a very simple rule here when you're thinking about this. And all we're doing is we're respecting how a trend forms or structure forms. Now, more often than not, when a swing low has been formed or a swing high has been formed, there's a very high chance that price will come back to that level. And there's a very high chance that if price comes back to this level and doesn't respect it and continues down, then the idea of price continuing bullish or bearish has been invalidated and you want to be out of that trade. You don't want to be holding trades with the hope that it does something. You want to be jumping into trades with the hope that it does something. And if it doesn't, just get out and move on to the next opportunity. So in a situation like this, very simple rule, we have nice structure. We have a swing high or a high low in this instance, and we believe that the market will continue to push higher without breaking the structural low. And if it does, then this is where I want my stop loss to be. Now, it's slightly different to the trend because the trend has to respect either this level. It doesn't make a higher high until it makes a higher high. And if it comes back to the previous higher low, then technically we're still in that uptrend. And if I just draw that in for you, you will see this. This is the previous higher low. This is the higher high. This is the higher low that is not confirmed until price breaks this high. So if it comes back to make a double bottom and continues up, we are still in an uptrend. So that's how you trade the trend. This is how you would work with a higher low, swing high, or whatever you want to call it. And we'll just assume that once the higher low is formed, we'll place our stop loss below this level and it will continue bullish. Okay, so that's the third rule of thumb you need to be thinking about here. The next rule of thumb is trading behind candles. Okay, so I trade two candle theory, I trade principle based trading, and let's say I'm identifying a strong sentiment in the market. The strong sentiment I'm identifying in the market is a really nice clear downtrend, price is making low lows, lower highs. We have a very strong bullish candle that is depleting, has now flipped bearish, and I anticipate the next candle to go bearish. The formation and development of a candle is wick first, flip, and continuation. So I identify the wick first, flip, and continuation. And I believe that as long as the market stays below the previous candle high, then we will continue bearish. Okay, very simple theory. If I'm taking a bullish trade and I identify that price is depleting, we're anticipating a pullback because we have a really strong downtrend. I trade the two candle theory. I'm identifying the development of a candle with a wick first, body next, and I see the flip. Then I want to place my stop loss below the previous candle and look for a continuation. Okay, so the rule of thumb here is placing your stop loss behind the previous candle in anticipation for the market to continue in that direction immediately. You're not waiting for any lower highs, higher lows. In actual fact, you technically are trading a trend, because if you go down to the 1 minute time frame, what you start to see here is a development of a trend. Okay, higher lows in anticipation of a higher high. And then in the instance where we were looking at the sells, here we have a 1 minute trend. Okay, lower lows, lower highs in anticipation for a continuation bearish. So somebody might say, well, this is not trend trading. This is whatever. I'm not interested in the argument. Whatever time frame you're trading on, you scale down to a long enough time frame, you'll be trading a trend. Okay, that's what intraday traders do, day traders do. And if I'm not speaking for everyone, then I'm speaking for myself. Okay, so the rule of thumb is to place your stop loss behind the previous candle in anticipation of a continuation, which is obviously a short-term trend on a lower time frame. The final rule of thumb here, guys, and this is a more aggressive approach, and this is not going to be for the faint-hearted. This is going to be for those that have a lot more experience in the markets, that are a lot more confident with their setups, that really trust and believe in what they're doing. And that is placing your stop loss behind the current candle. Okay, so this candle is closed bearish. Very strong bearish candle close, very strong volume and momentum. The previous candle closed bearish. I anticipate the next candle to go bearish. We have a nice wick formation, which is the development of a candle and a flip. And I place my stop loss behind this point in anticipation for price to continue bearish. Okay, this is the current candle. Now, the reason why this works is because I believe that the development of a candle's formation is wick first. I don't believe that is what it is. Wick first, body next. Once it flips bearish, don't jump in front of a moving trade. We should continue moving bearish. Wick first, body next. Currently red, should close red. Bam. In the trade, stop loss behind. If I get stopped out, I accept it. I'm not asking the market to breathe. I'm not asking the market to pull back. I'm not asking the market to do anything other than to continue in the direction that the market is currently going, which is bearish. Okay. If I'm trading bullish and I identify, let's say, a green candle close, and I anticipate the market to continue bullish and the development of a candle is wick first, body next, I'm asking the market to continue to push bullish because you are currently bullish and I don't want to jump in front of a moving train. So the idea is once you are now bullish, you should close bullish, and I'm going to put my stop loss behind this point here. Just forget that this is 1 pip. Okay, guys, just assume that it's 10. And this is how I want to take the trade. So the 5 principles that I follow are based on trends, key levels, swing highs, swing lows, previous candle close, and current candle close. Now, I'm not saying to trade or put your stop loss behind these levels in all scenarios. You need to find the ones that you are most comfortable with. And then once you've found that sweet spot, when you take those trades, you're going to feel more confident because your stop loss is in the right place If your stop loss gets hit, it wasn't that you was wrong. It was just that the market wasn't playing out for you in your favor. Put your stop loss in the wrong place and be stopped out when you're not comfortable. And then you're going to say to yourself, I done it wrong. And you don't ever want to do it wrong. You just always want to be taking trades that you're fully confident with and that you can rely on consistently every single day without fail. So guys, I hope you enjoyed that video. And if you did, please make sure you hit that like button, subscribe, turn on those notifications. And until next time, as I always say, continue to trust the process.